at-risk capital, their vehicles to invest directly or through funds. We come to the next session now, and we know that as India continues its journey to becoming a global innovation powerhouse, family offices are, of course, playing a key role, pivotal role in shaping nations' tech-driven growth. And therefore, we are at our next panel where we look at the role of family offices, especially in supporting the tech and innovation ecosystem, and how this is charging and powering the India growth story. I would like to invite upon the stage Amrit Moga, Deputy Head, UKPI Berger Paints Family Office. Amrit brings deep insights in leveraging family offices, expertise towards strategic innovation investments. Shashank, unfortunately, couldn't have been here. He's been down with a viral. We have with us Juhi Agarwal, CIO at Scan Holdings Group, whose work is, again, catalyzing family offices funds towards emerging sectors. We have with us Rajiv Gupta. Rajiv is the Managing Director and Senior Partner at BCG. And has many, many years of expertise and experience in business transformation and scaling innovation. And moderating this session is our ever-reliable Kunal Khattar, founder of Advant Edge Founders, who is himself a leader in venture investing and a champion of fostering entrepreneurial ecosystem. Let's welcome this exceptional panel. Over to you, Kunal, leaving it in your reliable hands.
Great. Thank you so much, Vasna. Good afternoon. Welcome back from tea, coffee. I hope you guys are caffeinated out. And 40% presence, not bad. I think we've done doing better than the last panel in Singapore, right, Nitin? This is amazing. Yeah. Yeah, much better. That's definitely upgrade. So as the topic goes, we've already had a couple of sessions. I mean, Capital Connect is all about bridging and bringing together investors, capital allocators with capital deployers. So I think one important thing that's happened in the last 5 to 7 years is the growing importance that family offices, especially legacy family offices, and we've seen an increasing role that they're playing, whether it's coming in as limited partners, coming in and co-investing with funds, or ultimately playing a significant role in providing liquidity through strategic acquisitions and M&A. So I'm very happy to have members from both the family, people representing family offices, as well as Rajiv, who's coming and talking, brings a slightly different point of view, more from a consulting and an industrial point of view. So why don't we start by having a small round of introductions and talk a little bit about in terms of, what role they are playing in this whole area, in the whole startup ecosystem, and what are some of the expectations from both this event and why we are here and what we hope to achieve.
No, sure, thank you. And you introduced me as somebody with a different point of view. Let's see how far that goes. My name is Rajiv Gupta. I'm a senior partner with Boston Consulting Group, BCG. I lead our, amongst other things, our digital and tech practice, which obviously you can't have any session like this without using phrases like AI or Gen AI. So that's what I've been doing. I've been a technologist since 1997 and been seeing various waves of tech happen in the last 27 odd years. Hope to be able to share a perspective on that. Juhi?
Hi, everybody. I'm Juhi Agarwal. I'm representing Scan Holdings Family Office. We are a family-run business into metal packaging, which is a very unique field, I have been told. And we are predominantly investing in listed space and derivatives, and we have our own in-house research team for most of the investments that we do.
Great.
Yeah. Hi, everyone. Good evening. I co-founded VNAM Advisors, which is a multifamily office firm, along with my colleague Vishesh. So in our understanding, family office is still a very confused concept when it comes to India. It is more oftenly just linked to the investments and managing the passive wealth. But our definition is, of course, managing the passive wealth. But beyond that, it is about institutionalizing the decision-making process within the families of high net worth individuals, high net worth business owners. So we play a larger role of consolidating the social capital, the networks and extensive relationships of the families, and how that can be leveraged and passed on to the next generation. That kind of larger role we are trying to play at our firm, which we created almost 4 years ago. Yeah.
Great, thank you. So I guess let me start with you, Amrit. Let's start with the 40,000-foot view. Since you're managing not only one large family office, but you're also doing multi-family offices as well. If you could just walk us through in terms of how things have changed and what has been the impact that, in your opinion, family offices have been playing in terms of driving innovation on more on the private side and in terms of economic growth of India as a whole.
Sure. Thanks, Kunal. And in fact, thanks, TiE, for inviting me over here. So, see, most of our clients are business owners. They are either the first generation entrepreneurs themselves, or they are multi-generational traditional business owners. I don't even need to explain what kind of impact, economic impact they're already creating through their existing businesses. But when you see their approach, the approach is no different when it comes to their passive wealth as compared to what approach they follow when it comes to their business. So, of course, some part of their passive wealth is stored for preservation, not meant for growth, but larger part of wealth gets reinvested either in the business or somewhere else, and somewhere contributes towards the economic growth. This is the basic nature of money that, nobody can hoard it or store it, not in family offices. It has to circulate. So family offices, and rather these business families, they have been reinvesting their money back in business, whether that is through capex for growth, whether that is, venturing out into some allied sector or in some sort of inorganic growth. So that is one fundamental way in which they are contributing to and towards the economic growth from their family office money. Then lately, you will see that there's a pattern that Delhi NCR, or rather promoters within the North India, on the North India side, you will see that they are not heavily invested towards startup space. But lately, they have started understanding this space. They're starting to understand this space. And it is not voluntary, it is out of compulsion. They understand that, they can't stay away from it, because you don't know, even from your business point of view, what is coming, what could disrupt your business in no time, and in fact, what could even bring in more efficiency in your business. So you have to be part of this space by compulsion, even if not by choice. So they have started taking keen interest in the startup space, whether that is through taking a LPGP position in funds or maybe doing direct investments. So that kind of impact also family offices are now trying to create, and that contributes to the economic growth. So, and let's not forget, the family offices are one of the larger investor categories in capital markets also. In fact, my co-panelist Juhi will talk more about in the kind of tremendous returns they are generating over there. But the growth of capital market in itself contributes hugely towards economic growth of India, and family offices play their part in that. Family offices invest hugely in the debt market also, in the bond market also, that somewhere supplements the traditional banking or non-banking finance sources. That also creates a huge impact. So all in all, I would say the contribution of family offices sometimes gets unnoticed or not gets recognized to an extent it should be, but the impact is huge, no doubt. The question that we should be asking ourselves is how we can derive this huge pool of money towards some impact-driven strategic sectors, maybe some sort of pooled vehicles wherein funds like your fund plays that kind of role, and family offices are starting to build that trust and going in there also in a big way. Thanks.
Great. Okay. Thank you so much. Absolutely. I think the importance of family offices are going across asset classes. So, Joey, quick question. So TiE's, of course, entire mission is to foster entrepreneurship. So we're very keen on opening up doors between potential capital allocators like yourself. But I get to understand that a majority, if not all your investments have predominantly been more on the public markets or equity side, very limited, and you've significantly outperformed that. So just want to get a sense of in terms of what has been your guiding philosophy from an investment point of view, and how you were able to achieve such significant sort of returns on your investments, and how does it align overall with the, long-term focus of those families that you represent?
Well, I think the truth and the core essence lies in the fact that you have to be extremely, extremely diligent about having a clear mandate for your family offices, and also a very methodological approach to decision execution. I think that for family offices plays a very crucial role, because when you have multiple parties who are involved in decision making, it can get very chaotic, right? You have to have some structure in place, which is the governing and the guidance that you need to follow. So that is the primary aspect. Like all good family offices, there are some key rules that we try to follow in our family office also. One is the fact that we only invest in businesses which are fundamentally strong, irrespective of how lucrative the valuations may be. You might be getting something dirt cheap, but don't go for it. It's a valuation trap, because good times don't last forever, and then when the bad times come, those investments are going to be 80% down, and your portfolio would be dragged beyond limits. Second thing is, we are very focused on investing only in businesses we understand. You don't have to have your hands and legs everywhere. Just be focused in your approach and do what you're good at. You shouldn't be doing everything just because just because it's a fad in the market. The third thing is, we are very, very, very strict on our entry and exit points, which I think plays a very crucial role for us. And any sort of revision in those entry and exit points has to be supported by very solid reasons of why it is happening, and a full analysis of if it is to be approved. Then we have a system of checks where we have 3 people with differing opinions who have to approve each investment before we start building positions. But I think all good family offices do that, right? So then how are we standing out, and what are we doing which is different, and how are we beating the market? So that lies in our little secrets, which I think I'm going to share out today. And that secret is twofold. One is our proprietary models, which we have developed for stock screening, elimination, selection, and scrutiny at different stages, from fundamental, technical, and quantitative points of view. And we run it over through 32 different parameters, which I think it's very comprehensive in the way we approach our stock selection. And second is our trading strategies for derivatives, which brings me to your second part of the question. I think derivatives as an asset class and as an instrument is, by family offices, is particularly considered to be a very speculative instrument. But I want to highlight this and bring this to knowledge that if used intelligently, it is rather a catalyst to your alpha generation process than becoming a deterrent or a risky asset class. Because I think somewhere along the way, I don't know if fund managers are to be blamed for it, probably not, but we have become very comfortable with the fact that illiquidity is okay in portfolios. So I think it's a little different way to think about it, that maybe you shouldn't be too comfortable with illiquidity in your portfolio for 6 years, 7 years, 8 years, because you can still generate alpha while having some liquidity in your portfolio, if not all of it. So I think hedging portfolio through derivatives plays a very, very important role in also bringing down your investment costs, right? You can be a long-term player and still have derivatives play an important role in hedging your positions, not just in equities in the listed space, but also overall as a part of your entire investment strategy. So I think the mindset comes from the fact that we want to be net cash flow generators on a month-on-month basis than just long-term investors with a 10-year timeline in hand.
Okay, great. So I see some similarities stick to your lanes, be consistent, and let your returns compound, and some significant differences between public and private market. And we also take significantly higher risks. So that's great. So Rajiv, over to you. From your point of view, so what are the steps? That's more of a macro question, not necessarily from a family office point of view. But if we talk about what kind of what's happening in the industry, Let's talk a little bit about what kind of steps that the industry can take to encourage sustainable innovation, because innovation, of course, is a key driver in what we're doing. And we're seeing so many long-term outcomes of what we're trying to do here. We talk about innovation across areas such as clean energy, artificial intelligence, deep tech, sustainability, and inclusion. Just sort of from your point of view, what are some of the future forward initiatives that you think that we should be focusing on, whether it's investments from the family offices or from in funds like us or strategic investments?
No, actually the last 13 minutes have been very educative for me. So I do a lot of work in topics that people don't necessarily understand at that point in time and looking ahead. And that would be some fairly cutting edge technologies. Don't want to throw jargon here. And you use quite a few of them, whether it's sustainable, whether it's electric vehicles, whether it's deep tech. You can get into various other areas. We as a country have benefited. When I graduated back in 1995 from my undergrad engineering college, nobody really wanted to get into entrepreneurship. Nobody wanted to do a startup. Any promoter was seen with very weird eyes that, okay, there must be some scam or some scheme out here. That world has changed dramatically. When now I go back to my same college for recruitment, and half the 22-year-old kids are looking for 100 crore funding to start their own idea on something very advanced. So my big learning has been that in the last 10 years or so, as India has really evolved into innovation and entrepreneurship, largely led by digital tech and AI, folks like us have worked with various firms to help fund. Most of them have been PE and VC funds. So my learning over the last 13 minutes has been that we should be coming and speaking more to family offices as well. And with due respect, Juhi, actually figuring out how to encourage that we go out of the comfort zone of not only what we know, but also be willing to experiment. And what happens is, as I have looked at this journey over the last several years, people have experimented with small funds, small amounts. No big deal if you lose it. And then they've been able to exit with a good outcome. Then that exit has become the baseline for the next fund, and so on and so forth. So that would be great to have family offices participate in this big tech revolution, which I was just doing a little news bite earlier. I believe the tech revolution, and you can add words like digital and AI and blockchain and every other term that comes with it, has become fairly tripolar. It is big in US, it is big in China, and it's big in India. Actually, the decline after these three countries, there is no other fourth country that comes close to this. So how can we drive that? Within that, India has some key problems. So the more we can focus on a few themes and go deep into them, rather than having 1,000 flowers bloom and do lots of small little things which do not have impact on a country of our scale and size, that would be good. That, I think, with Niti Aayog, there's a very, very clear view of what our strategy has been. And in some of those areas, that you called some of them out, like clean energy and so on, that would be very useful.
Amrit, so the fundamental things we've seen with family offices, of course, is the next generation getting involved. So typically, if you look at the legacy businesses, right, the original promoters who created that business have a very different way of thinking. And now we are seeing the next generation come in who have a slightly more different and a more evolved way of thinking. So just want to, and probably that's more aligned with where we come from TiE's perspective of, mentoring and encouraging entrepreneurship more on the technology side, which are at the end of the day more cutting edge. So in your experience, have you seen a strategic and a significantly different way in which the next generation is thinking about taking exposure to different asset classes? And how have you gone about in changing strategies to bring about the objectives of the second generation?
Great question, Kunal. In fact, this is a question that we come across on a very frequent basis. So like at our firm, VNAM, and even before that, one of the key focus areas for us has been succession planning. wherein the families or the patriarchs, they always think, how to induct the next generation into the business, or in whatever role they want to play, or they want to start something of their own. That is always the key question, because the next generation always comes with new energy, no doubt, different perspective, different objectives, and different risk appetite and aggression. So and the family needs to address that. So there are multiple ways through which we have been trying to address that. For example, there are younger generations who want to start something of their own, like with an entrepreneurial mindset. Families have kept a small pocket of their family office corpus as an innovation fund, wherein they fund their seed fund their innovative ideas. In fact, yesterday only we had a 3-hour family council meeting wherein the younger generation was pitching in their ideas. So that kind of an innovation fund is being allocated, and the families, younger generation are being funded for their new ideas wherever they want to invest in. Then there are also younger generations who are with high risk appetite. They want to invest in new asset classes like crypto. Like I believe myself to be of young age only, but still I'm not able to understand crypto, and I don't think I'll be able to. But they want to do it, so family, instead of discouraging it, they allocate some amount of money to them so that they can experiment, they can invest, they can learn whether they make money or lose money. But the thing is, they will learn out of it so that they are ready for the larger responsibility when the time comes. So, and even for the younger generation who wants to be part of the business, that planning starts early on. They get inducted in the company and they have to grow in the company ground up. So they train across multiple functions under multiple vertical heads, so that they get prepared for the board representation kind of a role and the leadership they will have to play at some point in time. So having said that, the families or the patriarchs are empowering their younger generation in whatever field they want to go in, whether that is their own setup, entrepreneurship, whether that is to do something with investing or in the new asset classes, or whether that is being part of the business. So that kind of flexibility they are doing, and they're allocating enough resources and enough mentorship programs for them, and all these kids studying abroad, doing their internships. So they come with bright ideas, like my co-panelist, you mentioned that, how we can engage more with family offices in tech-focused investments. The younger generation plays a larger role in doing that, in driving that, because the older generation relies on the experience and the learnings and judgments of the younger generation in taking those small bets and then going in a big way as they learn more on their journey. Yeah, thank you.
No, very good. I mean, so significantly different ways of thinking of the newer generation versus. So taking forward to what he said, Joe, you'd like to sort of get a sense in terms of how has your asset allocation strategy evolved over time. So you clearly look at investing across public markets, whether it's derivatives or equity, but has there been a change in the way you look at investing in technology versus more of the legacy businesses, more traditional businesses? And are you seeing now greater allocation and exposure to businesses that are more volatile in nature?
I think that's definitely the case, because I think the way family offices have evolved with the, actually it's chain reaction if you really think about it. With the current government in the center, I think all of our hopes and aspirations have all of a sudden amplified from the India that we imagine in 2010 versus the India that we see now, right? And how things have changed is that globalization was always in place. It's just global mega trends were never really focused areas in India also. So I think that shift has happened because we see a lot more economic and political and social stability within the country. And with that happening, the global megatrends have also become a part of the culture within India in all spaces: digital technology, automation, AI, deep learning, machine learning. All of these things have actually, they always had the potential. They never had the right grounds to breed, right? Now they get the right platforms to develop themselves, and there's a lot of encouragement. There are a lot of new funds which are coming up encouraging these young entrepreneurs. So we also see that allocation increasing to businesses which are going hand in hand with the new age concepts, because we understand that one has to keep changing the way the markets are changing. You can't have a contrarian view on every aspect, on every business. You have to move with the flow. And why would you not want to? If you see that technology today has become not a segment of investment. Technology today is rather an enabler of investments and an enabler of industries. So when it is an enabler of industries, you can't be out of technology and say that, no, I just invest in Infosys or I just invest in a business like TCS because it's a good stock that is performing well. Versus, no, you have to be a part of all of the fintech and the wealth tech platforms or ed tech platforms which are coming up, because they are going to shape the country 10 years or 20 years from now. So I think that shift has happened because the globalization impact in India can now be felt and understood much strongly, much deeply. And families have restructured themselves. As we're talking about next gen, I am actually a next gen, I think, because I'm a second generation in our family. And of course, if I would ever take an idea of cryptocurrency to my parents, they would be like, it has no grounds. But it's a conversation starter. And once you start getting into those conversations, you may reject 5 ideas, but then they will understand 3 others, and then they will subscribe to it, right? And I think how the industry has changed is that we have also become not just consumers of technology, rather also producers of it. In our family office, we now see that, okay, there's a gap in the market because this software doesn't exist, or there is a gap in the market because this kind of industry needs this technological development. So we become active participants, actively speaking about people that what kind of solutions can be generated, which tomorrow becomes businesses which are funded by likes of yourself. So in that space, I think market is now understanding what they need. So they are able to demand for it. Initially, as they say, people would think something can be done, but they didn't have the means to. Today, they are becoming the enablers to make those things happen. So I think that's a big change and shift in the culture and in the way investments are happening in family offices.
No, thank you. So sticking broadly in the same theme of technology investing, Rajiv, just want to get your sense in terms of what would be your point of view in terms of building an investment portfolio more aligned with India's changing economic priorities, and we've seen those evolve over a period of time, whether it's regulation or whether it's the central government or state governments. So just give us a point of view, given your vantage point of having worked both with potentially late growth stage startups as well as a lot of the traditional businesses. What would be your recommendation in terms of somebody who wants to build a strong portfolio across tech startups and all, but you also want to align it with India's priorities or economic priorities?
Sure. How many of you here have heard about the Tech Frontier Hub by any chance? Nobody? Okay, so this is a new initiative that was launched by the Prime Minister's office. The previous president of NASSCOM, Debjani Ghosh, was asked to lead it, and comes under Niti Aayog's leadership, but reports directly to the Prime Minister's office. What the Tech Frontier Hub effectively was tasked to do, and there's been a lot of thinking last year as the launch happened, is what are the tech priorities of India? As part of, say, Viksit Bharat or whatever, and looking ahead, not to 2030, but also 25 years from now, what are the tech priorities of India? And a few themes came up. Some 9 or 10 key themes have come up. Some of them are about cutting edge technology. So today, India has a tech services portfolio that has been fast growing. And you mentioned likes of Infosys and TCS and all. And the tech services portfolio, which is over almost $250 billion today, pays for all of our imports of oil and natural gas and so on. It is one of our largest sectors, really. So there are technologies that help one of our largest sectors that has always been growing at a double-digit pace. Then there are technologies, but that is effectively the engine room, where India becomes the engine room for serving large parts of the globe. The second part is actually India for India. But given the India consumerism, what can you do that is cutting edge work to provide to the Indian consumers, and the likes of Zomato, Ola, Make My Trip, etc. are good examples of that, and more in the India for India. The third category is what helps solve some of the biggest problems of India, whether it is energy, whether it is Swachh Bharat, whether it is agri-tech, and so on. So that's the third category of things. My recommendation now to in response to your question is, as you think of a portfolio, and I'm no investor, I have no understanding of investments, I do SIP in mutual funds and so on. So, but as you look at investment, and the last I studied about it in my B school, it was about having a portfolio that is balanced. Within that balanced portfolio, tech could be one of the parameters of balancing it. But tech, given it's a ubiquitous word and can mean anything and everything, within tech, especially from an India standpoint, you could balance it across these three themes that I talked about. And some of those themes can therefore be a bit more cutting edge with a higher beta. Some of them could be things that are absolutely needed and are well established. But that's how I would think about it. And I'll just conclude my answer with an example here. So I was privileged to work with Nissan a few years back. So before COVID happened, Tokyo Olympics was supposed to happen in 2020. Different story that had happened in 2021. And Nissan was a big sponsor of the Olympics. And as part of that sponsorship, they were going to launch Leaf, which was their fully autonomous car. A fully autonomous car is less automotive, it's more software. Nissan was struggling with the speed at which they needed to deploy the software. So they came to India because India is the land of large scale software development, and they set up a center almost overnight to help them drive that software. So you had a manufacturing or whatever, you had the headquarters in Yokohama in Japan, you had software development happening in India, and you had user design happening in Palo Alto in US. And this is how things were working. And one of the technologies that they talked about was haptic technology. I'd never even heard the word before. Any of you heard haptic here? Okay, few. So it's quite interesting that when you design a car, what is the angle of the bonnet that leads to the headlight is a very key parameter that defines the shape of the car and the fuel efficiency. But you can't just keep producing different angles and testing it. So you have to test that through software. And then you wear these haptic gloves. These are actual physical gloves that you wear, and you can actually feel in the air what that curvature can look like. So you're actually touching the air, but because of the technology, you can actually feel the metal into the light. Very, very cutting edge technology, but proving to be a big element of investment as far as smart cars and EVs and so on go. So I took this example to just talk about the kind of range of technologies we can talk about and how you balance that in your portfolio.
So Amrit, you know, and this I guess comes from my personal experience, having two large institutional or family offices in our fund, is they bring a lot of strategic technology leverage or advantage to our portfolio companies. So Motherson and Hero are two, and I run a mobility fund. So just want to get a sense in terms of, so it's not just about capital, right? It's, you know, that's probably the beginning of a relationship. Now, you are representing Berger Paints, so they are world-class companies with deep tech in that particular domain. So when you make investments, many times there will be startups that you end up deploying either through your LP network or direct investments, where you have the ability to leverage Berger's ecosystem or technology or brand or distribution to bring value. If you could just talk a little bit about how this is a two-way street, not just a single-way street, unlike traditional LPs who just deploy capital, and how is that helped, and maybe with some specific examples from Berger Paints with the potential startup, and how is it that's accelerated or created the right to win for that particular portfolio or portfolio in a company that you ended up investing in, and how was that a win-win for all the stakeholders involved?
Okay, so I'll not specifically talk about Berger because as a matter of confidentiality, see, our clients are in multiple diverse sectors like paints, of course, then real estate, infrastructure, textiles, hospitality and all. See, all these business families, they have deep expertise and knowledge base in terms of manufacturing, distribution channels, sales channels, market dynamics, use cases. this knowledge is a huge wealth, and they understand that they can leverage this wealth by actively engaging with the new age tech companies and new age startups. I can't share the specifics, but I can definitely say with confidence that we are actively engaging with the incubators, the IITs of the world, in terms of sharing our use cases that we are seeing that are going to be needed in the future, and letting them do the innovation and collaborating and jointly developing the solutions. Joint trials are happening at the R&D facilities, and much more. We are very open to providing them any kind of commitment, not just the capital, because we are not looking just the financial returns. It's more about how it can add on value to our businesses. So we are ready to provide them with capital, of course, then also purchase commitments, or access to our social networks. Like I mentioned in the beginning, the most undervalued asset of these family offices and business families is their social capital of vast networks and relationships they've cultivated over time. So giving that kind of access to these new age companies and giving them right mentorship, right connects to the right customers can really help them accelerate. And we try to play that active role by engaging actively with all these incubators, IITs, and such other more sources. So, and you'll see, and you will, there'll be a lot of announcements coming in on that front, but I can't really talk about specifics. So to give you one more instance, one of the families, like they've tied up with a European company to set up a green hydrogen electrolyzer plant in India, and that's now up and running and recently launched. So those kind of things are happening at multiple fronts in multiple families. So yeah.
Thank you. Amazing. Yeah, hopefully we get to hear more and more exciting things about how LPs are contributing to the success of startups. Back to you. Your first question, you sort of talked a little bit about in terms of what your core strategies has been that's allowed you to give alpha returns. So we live in a very volatile market. Of course, now we've had consistent year-on-year growth in terms of public markets, which is what you're experiencing. So now let's do a little bit of crystal ball gazing and look 3 to 5 years down the window. Are you going to continue the same strategies, or do you think it's time to have maybe a different way in terms of tweaking that strategy and looking at alternative ways in which you can continue to sustain those kinds of returns?
I think one rule doesn't apply to all situations, and I think investment strategies have to be ever evolving because the markets are ever evolving. So it's really to say that one has to understand where the markets are headed and move in line with those directions, as I said previously. Interestingly enough, I had the chance to have a one-on-one meeting with the IFSCA chairperson, Sri Venkat Ramanji, and I was also in discussions with India's ex-chief economic advisor, who's also presently, IMF's executive director. He's written a book, Dr. Subramaniam, and with both of them independently, the conversation ran about Viksit Bharat, right? What you were mentioning just now. And the entire discussion was about the fact that India is growing not in specific segments, but as a country as a whole. So there are policies in place, there are systems in place which are bringing India forward in all different spheres of business, right? And how we, as investors and as family offices or as enablers of technology, play a role in mitigating the process of, or fastening the process of that development, I think is very crucial for us to implement. And of course, asset classes and asset allocation is a forever thing. It's never going to end. You can have, traditionally businesses were only investing in gold and real estate, and then somehow fixed income concept came in place, and then listed equities came in place, and now we are at alternatives, and I'm sure there are going to be 10 other different products in the market coming up 5 or 7 years down the line. So the focus shouldn't be on asset class, the focus should be to select the right sectors. How you choose to invest in it is just a means to the goal, right? The goal has to be very clear, which has to be clearly written down in the mandates. of what sectors you see as high growth sectors and where you make the maximum value out of in this high growth period. And I think for a country like India, we see at least a 20-25 year period where this growth is going to be a very sharp curve. So it only depends on skills and your eye for detail on where you are able to get the maximum value derived out of.
Great, thank you. So I guess my last question is talking more about, I mean, if global markets were not complex enough, I cannot sort of stop but talk about the Trump effect. So Rajiv, this is my question to you. India is, of course, the world is flat and we're affected by decisions or strategies or policies, whether it's China, America, both inward and outward. Now, of course, we've got to deal with the Trump effect, probably a very volatile decision maker, policy maker. He's not, I mean, in some ways he's consistent, is the fact that everything that he does is inconsistent and unpredictable. So from India's point of view, I guess fundamentally the question is how does one strategize, how does one rationalize, strategize and profit from the uncertainty that's going to happen from a global perspective, from India's point of view?
So on one hand, you just said he's consistently inconsistent and unpredictable. And then you want me to predict what? Okay, that's interesting. Look, honestly, I don't want to share any political views or have any geopolitical depth here. I do know that since his election, the tech industry globally reacted positively. And I also know that the Indian tech industry has reacted quite positively. Davos is just concluding, and there too, as we met the leaders of various Indian tech leaders, from a business standpoint, there was a general view that it's good for business, it's good for their, and there was no, there are issues to be dealt with, but no panic, get on with life, and hopefully with lower taxation and so on and so forth, the economy should thrive and Indian tech sector should benefit from it. So that's to the extent. Beyond that, though Nostradamus died a few centuries ago, I'm not his reincarnate.
I think even God doesn't know.
Okay, great.